Hey, thanks for tuning into the video. My name is krystallis. I'm the founder of ExitDeals. And within this session, you're basically going to watch me and Denis Mezheritskiy of ROI Business Brokers, which is a business brokerage, discuss the key tips and methods to basically value your business. And on the flip side as well, how to increase your business's valuation by either increasing your business's LTV and a couple of other strategies as well. If you like this session, make sure to check out the full podcast, which is linked in the description below. Listing themselves incorrectly with regards to asking price, etc. Just as a baseline, let's say for viewers that are interested in pricing strategies, what's the best way to price? How do you get a valuation, etc. Just the basics of it.
Well, I mean, it's a loaded question. There's so many different ways to value a business, right? There's the asset value of the company. There are some asset-heavy companies that the asset value of the company will outweigh the enterprise value of the company. For example, take a good-sized trucking company. The equipment value of those assets might outweigh the actual enterprise value of the business. Or take a jewelry store, for example, right? A jewelry store, their inventory, their assets of the company will outweigh the enterprise value of the business. And then so that's one way, right? Look at your assets. What is the current market price of those assets? But the most valuation method that we use is called the direct to market approach, which what we do is we look at the cash flow that the company produces. So the bottom line discretionary income or EBITDA of the company that the company is able to produce on an annual basis historically. So valuation is a historic, right? We're not like forecasting the opportunity. Like based on the historic assessment of the company, the value the company is able to produce so much cash flow every year to their owners per year on average. So we take that cash flow amount and we compare that business, that cash flow and the business that it produces to the same similar businesses in the industry. So if you take, for instance, you take a home health company, we can go through the financials of the home health company. We can understand what is the cash flow each year this company produces, what's the EBITDA, and then we can go back to our comparable reports and we can see, well, companies in this sector have sold 2.5 to 3.5 times the cash flow that the company produces. Just
So is it an industry multiple?
yeah. So so the multiple that we look would be the multiple is always a range, right? There's a low range and then there's a high range. There's companies that sold that could be 1.5 times the cash flow, EBITDA or discretionary earnings, and it could be up to 4 or 5 times the cash flow. So where does this company fits within this parameter? So we really have to break down the company and look at the risks that the company has for this particular buyer to really understand, where is it more on the lower side, on the higher side, where is that multiple? But we look at the big sample of data, like we look at 20 different transactions in that particular industry, 30 transactions in that particular industry, and how does this company compares to the transactions that happened in the past? And that's how we're able to give an assessment of that value. But that just gives you the financial value of the company. There's some businesses that we represent that we do what's called a controlled and informal auction, is where we are looking for companies that could be a phenomenal strategic fit. So we would be looking for a company for how can we cross-sell different product lines and manufacturing that can take advantage of the retail sector. We're looking for that strategic buyer, and those buyers could potentially pay a higher price. So I'll give you an example of, for example, a physical therapy practice. If you take an individual physical therapy practice, 20% of the expenses are administrative costs. And typically in any medical practice, dermatology practice, 20 to 25% is billing, is admin, is all the appointment setting. There's a lot of cost that is admitted. Now, if I have an existing physical therapy clinic and I'm able to buy other locations, now my cost I already have that cost in my existing ecosystem. So now if I'm buying a practice somewhere that spends 20% of their revenue on administrative costs, that's cash flow for me. I'm not going to be spending that much money on administrative costs for the company. So I'm able to pay much more money for that company just because I have so much more cash flows coming to me. Now, so that's like a little bit of a strategic approach when valuing a company. So that's why we do a control auction on companies that we feel could be a good potential fit for those acquisitions.
Understood.
I know I
So
went on.
in that case, basically, there it's like inter-industry purchases, for example, primarily for like
Yeah,
strategic gain over the long term.
yeah, yeah. I mean, you take industries like service industries like plumbing or HVAC or electrical. There you can take a company that could be a good hub that has everything already established. It has all the invoicing, administrative, it could be a good, nice platform. And what happens with that's the private equity model. They buy a platform company that has everything already figured out, and they go out and buy those service companies from the business owners who started those companies 30 years ago. They do a great job, but again, they're spending a lot of money at admin costs, and they don't have all the processes figured out as well as a good platform company would. So for them, it's much easier to add on, and then you can go cross industry, and like HVAC company, and they can buy a plumbing company, right? And now they're able to cross sell services. So revenue models, like now we're making more money from the same database of clients. We can cross sell our product lines. Now our company is so much more valuable because, well, per client base, we're making a killing now, not really changing much of anything else. So
Mhm.
that's the model that we look for when we're representing sellers who are on the long term, we're looking to get a higher multiple size on that valuation.